Hey everybody, it's me, and I just finished wrapping up your lecture for tonight, the video that you're getting ready to see. And it dawned on me whenever I was finishing it that I had a couple of housekeeping things that I forgot to incorporate in there. So let me go through those really quickly, and then you can get on with the lecture. First one is, the lecture's about 30 minutes long. And I know that's shorter than what we do in class, but I also know that it's different just sitting watching a lecture on a screen versus interacting whenever we're in class. So take a break if you need to. I get that this isn't watching TikTok videos or sports clips or playing video games. So it can get a little bit more boring than sitting there scrolling for hours. Don't hesitate to just hit the pause button if you need to. That's fine. Second thing is, you guys have been doing a really good job of, if you have questions, reaching out to me to let me help you work through stuff. But I want to make sure that everybody understands that when you do that, there's two things you need to be aware of. Connect will not let me look at the work you're actually working on until you finish going through the whole thing and hit the submit button. So if you're halfway through an assignment and you've got something that you don't understand, so you want to pause and reach out to me, that's great. But I can't log in and see where you're at because you haven't hit the submit button. Now remember, you've got unlimited attempts to get these tax problems turned into me. So if you hit something like that, skip over it, work as much as you can without knowing that, hit the submit button, and then reach out to me. That way I can go in and look and see what you're actually working on. The other thing I want to talk about real quick is I want to show you something up on the screen. And that is, whenever you are reaching out to me, what really helps me is to know this information right here, where it says, for example, comprehensive problem 5-77. Or if we go back to the first part of this assignment, it is, come on computer, change over for me. Comprehensive problems 5-75. That lets me know which part of the assignment you're working on. And then if you have questions about specific steps, give those to me so I know exactly where you're looking so that we're looking at the same page. Last thing I want to talk about real quick is I know that a couple of you asked me to take a look at the differences between the questions that you were being asked in the Smart Book process and the questions that were coming in on the quizzes. And I know they're different. As I go back and look at them and I look at all the processes that we take, especially using Connect, they're different for a reason. Keep in mind, our plan on this is to bring you in soft, get you a general understanding of what's going on, and then move up from there. Just working through the Smart Book questions is probably not going to answer everything you need to know or give it to you necessarily in the directions that you need to know. Now, I know you all are reading the book, but plan on taking notes and thinking about as you read through the book, not only what are the Smart Book questions going to be, but how can this be reworded, rephrased to pose it to you on a higher level? Because that's what we're doing when we move from Smart Book into the quizzes, is taking your big general soft knowledge and starting to focus it down. Sorry, there's not much I can do about that. That's kind of the way the whole education world's built. So with that in mind, let me wrap up here, and it's time for you to get started on the actual lecture for tonight. Like I said, don't hesitate to pause. Don't hesitate to reach out to me. I'll see you guys next Thursday. Hey everybody, it's me. So I've got a couple pieces of good news. First one is, obviously, we're going to be doing this lecture on video, so you're not sitting in class today. The other thing that's kind of good about this is Chapter 6 is actually kind of a shorter chapter. So if it was going to fall on one of the weeks, it's a good thing that it fell on this one. What we're going to be talking about in this chapter is individual deductions. And to understand that, as I'm going to try to do every chapter, let's sort of take a look at where we're starting off at on the form. Before I do this, I want to get two thoughts sort of drilled into your head. You're going to hear me say this a lot, especially in the upcoming chapters. Here is how the IRS lays down the rules on what gets included and what gets reported on tax returns. When it comes to income, you are responsible for telling them about absolutely everything, and it has to be included unless the IRS specifically says, no, it doesn't have to be. Think about the exclusions that we talked about last week. You report everything, they tell you when it doesn't have to be included or counted. When it comes to expenses, they don't want to hear about anything unless they have already said, yes, this is going to be an expense that we're going to consider. Now that umbrella is huge, and we're going to talk about a lot of that tonight. So once again, when it comes to income, you tell them about everything. And if it isn't going to be included or counted, they'll let you know. And when it comes to expenses, you only get to report the items that they have said, yes, you can. So with that in mind, we are still dealing with this income section down here at the bottom. When we talk about that section and we tie it back to the formula, you'll notice this formula is a little bit more expanded than the one we've been using in your book. It includes all that top area of absolutely every penny total income and the exclusions that we talked about last week, and that takes you down to the gross income line. After we get that gross income line, as we've talked about, we're going to have to deal with some things before we come up with taxable income. And that one section is what we call minusing the deductions. When we look at that over here on the tax form, the top area is all the income that you've got coming in. The very bottom line is that taxable income. So when we're dealing with the deductions, it's this middle section right here, from line 10 down to about line 14 on the current tax return that we're working with. So how do we look at what goes into that deductions section? Well, to do that, we sort of need to look at what deductions, as we've said, the IRS has approved. Now here's the deal. The IRS is not going to look at absolutely every single item on every single tax return that's submitted to them. So what they've done is they've established a framework that has three major categories of types of deductions that are allowed. The first one is expenses that you may incur as part of a trade or a business. Remember, this comes back in if we're dealing with a sole proprietorship or a partnership, or for the most part, usually LLCs. What they're saying is, we realize you took in gross income here, but we also realize that you had expenses that you incurred to get that income to come in. So we're going to allow you to deduct those out in this first of the three categories. The second category in this framework is going to sound similar to the first one, but I want to make sure you understand the difference. And that is personal expenses you may have incurred that's connected with you personally producing income. Now, what's the difference between that one and the first one? The first one is you have an established, organized business that brings in income, and there are expenses that are incurred with that, so you get to deduct those out. The second category, let me use an example. You could be an artist. You don't have a company set up to sell your artwork. You're just an artist. You paint pictures, or you create sculptures, or you bake baked goods, whatever. So you're going to have expenses related to that, but they aren't a business expense because you don't have a business that they tie to. So that's the difference between 1 and 2. The third area is a set of deductions that the IRS has specifically decided to allow. And as we've talked about, that's going to be the result of congressional acts. So the first ones are expenses tied to business. Second one are expenses that are tied to you personally producing some kind of income. Third one are very specific things that the IRS has said, we're going to allow that as a deduction. So for example, if you pay certain types of interest, right now that includes mortgage interest that you pay on home loans. It could be interest that you pay on student loans, etc. Another category here is certain taxes that as individuals you pay. The government says that you bring in a chunk of money over the course of the year, and part of that is used to pay your personal property tax. Well, they understand that it's not fair that you are bringing this money in just so that you can turn around and pay it to another government agency for taxes, so they're going to allow you to deduct that off of your gross income and not be assessed income tax on it. Another area is you might have personal expenses for some very specific activities that they understand that it wouldn't be fair to tax you on that. So if you're making donations to charities, they want you to do that. They're going to encourage you to do that. So they're going to say, we're not going to include that in the amount of income that you bring in this year that you have to pay income taxes for. Or if you're going to set money aside so that you can use that when you retire, we're not going to charge income tax on that whenever you put it over into that set aside. Now, you will pay income tax on it whenever it comes out of that set aside, but you've got time to grow that amount to help cover those taxes. If you have large medical expenses in a specific year, there is a formula for saying we're not going to make you pay income taxes on all of that. So those are the three categories of the framework on the types of things that you're allowed to deduct so that it lowers the amount that you have to pay taxes on. So with that in mind, here we are back showing that formula that we've been working with. Remember, we're dealing with this one line talking about what can be deducted from gross income. I want to expand that out a little bit so that you can see it in a little bit more detailed form. So we start with gross income. Then we've got some areas in here that we need to be able to calculate our deductions. And then when that's done, we'll get down to the taxable income. This is the level of income that we're going to put into the tax formulas to determine how much income tax is owed. When we're looking at those deductions, as we've talked about before, we break those down into two steps. The first one is deductions that you're allowed to take for calculating what your adjusted gross income is. After that, we come up with adjusted gross income. And then from there, there's another set of deductions that you're allowed to take out from your adjusted gross income. And we talked about this a little bit the last couple of weeks, but especially last week. With that in mind, there's a couple things to keep in mind about these two different levels of deductions. For the most part, when you're making deductions for calculating your adjusted gross income, those are usually involved in earning income. So if you've got a company, it could be your company electric bill. If you're just an artist, it could be the cost that you had to sink in to make the products that you sell. Basically, everything that comes in the top are expenses that you've incurred to make your money, whether that's for a business, whether that's personal income, whatever. The stuff at the bottom, the deductions from adjusted gross income, those are more discretionary. They're more deductions that the government says, if you spend some money here, we're going to consider that an incentive to do things later on, like your retirement fund. And as I've mentioned to you before, when you go to apply for any kind of loan and you have to provide your tax returns, the line that the bank or the lender is looking for is not the gross income at the top, and it's not the taxable income at the bottom. It's the adjusted gross income. So with that in mind, there's a tricky part of this that I need you to keep in mind. And that is, there are some amounts that are determined for the top side and the bottom side that are percentages. And where that percentage falls, how that percentage is calculated, what level or what rate that percentage is based on your AGI. One of those is charitable donations. So if you take more deductions for calculating adjusted gross income, if you do that, if you are reporting your business income and you add lots of legitimate business income deductions in there, that will lower your adjusted gross income. Okay, that's usually a good tax strategy because it could lower the bracket that you're having to pay. But the thing to keep in mind is there are some deductions that come after adjusted gross income that are based on the adjusted gross income. So for example, the percentage of charitable donations that you're allowed to claim in the bottom part is set based on what your adjusted gross income is. So to say that a different way, if you didn't take all those business deductions, your adjusted gross income would be higher, which means that you would be allowed to deduct off a higher percentage of charitable donations, but then your taxable income could end up being higher, so that you could end up going into a different tax bracket. That also applies for medical expenses. Okay, that's a little tricky. Hopefully I've helped explain it a little bit here to make it a little bit more understandable whenever you go through it in your book. Keep in mind one other factor, and that is most of the things that are deductible in the top part, in the area for calculating your adjusted gross income, are not allowed in the bottom part. What do I mean by that? Well, let's look at an example. As part of your business may encounter legal fees or accounting fees. Those are considered business deductions whenever you're trying to calculate your adjusted gross income. But once you've calculated your AGI, those are not deductible as personal expenses. So if you have an accounting bill for calculating your taxes, that needs to be considered a business expense because as a personal expense, you're not allowed to deduct that off. Okay, so that sort of covers what deductions the IRS approves. Next, we need to get into, and we talked about this a little bit some last week also, when is an expense allowed as an actual business expense? Well, there's some criteria that have to be met for the IRS to say, yes, we're going to consider that a business expense. And remember, what we're talking about here is all the framework that's in place, because the IRS is not going to sit and look at absolutely every receipt you submit this year, saying, yes, that can be a business expense, and no, that can't. This is the framework. If you can say something meets these criteria, then yes, you're allowed to use that as a business expense. Number one, it's got to be directly related to earning income for the business. Number two, it must be what we consider ordinary, which is customary for the business. Remember, I talked a little bit about the example of you go to Costco and you buy steaks and you buy a case of printing paper. When are those things ordinary? Well, if you're in a real estate business, yes, the paper is going to be considered ordinary. In fact, even in a restaurant, the paper would be considered ordinary. If you're running a restaurant, the steaks would also be considered ordinary. But if you're running a real estate company, those steaks, buying steaks as a business expense may not be considered ordinary. Unless you can say something like, we're doing it for customer appreciation. We're doing it for employee appreciation, whatever. But then you really do have to use those steaks for that purpose, not just use that as an excuse to buy steaks and take it home and put it in your freezer. The third thing that we talk about here is it's got to be necessary for the business. You see the parrot picture up here. We talked about parrots last week. Can we really say that buying a parrot is necessary, the example that I used, for an international adoption agency? No, probably not. There isn't a reason for that type of business or nonprofit organization to have a parrot. The next point is that those purchases, those expenses have to be properly documented. There has to be documentation. Nowadays, it could be an electronic version of a receipt, or it could still be a paper version of a receipt. But it has to show who you purchased it from, who you paid for it, how much you paid for it, when you paid for it, what specifically was it that you purchased. And then the final point that falls under this framework of deciding whether an expense is a business expense is it has to be the taxpayer's expense, not someone else's. So if you're dealing, let's say, with a small business and one of your children went and bought $40 worth of steaks to use on their own, not only is that directly related to earning the business, it's not even the taxpayer's expense. So you can't grab receipts from someone else for things that they purchased and then claim them on your taxes. Okay, something else that we need to talk about is what's not allowed as a business expense. Now, that doesn't mean that you can't spend the money on it. I'm just saying that it can't be reported on the taxes, that money going out, as an ordinary business expense within the year. If you're making a capital expenditure, you're spending $500,000 to buy a backhoe, that isn't going to be considered a business expense because you're not going to write that all off in the year that it was purchased. You'd end up depreciating that over a series of years. Now, that depreciation expense each year would be considered a business expense, but the capital purchase isn't. You can't consider it a business expense when it's spent to earn income that's already been ruled as tax-exempt income. So if you're spending something to bring income in, and the government's already said that's an exclusion, we're not going to tax you on that, then the money that you spent to earn that income isn't considered a business expense. Here's another part of this is if you are making business expenses to purchase things that are violations of public policy, and that's not only bribes, but fines or penalties, or you're buying stuff that you shouldn't be buying, you don't get to consider that a business expense. If it's illegal, you don't get to consider it a business expense to not have to pay taxes on it. Remember Al Capone. One of the things that falls in here in a big category is political restrictions. There are a lot of things that the government says you are not allowed to spend money on lobbying for specific political issues and then turn around and get to consider that a business expense. But let me mention something here that sort of falls into a couple of these different categories. As you can see right now, I've got a marijuana plant leaf up on the screen. Think about that for a second. We're talking about federal income tax. So if a business in the state of Missouri, let's say, is a dispensary, and they're spending money to purchase marijuana to turn around and resell it, the federal government still says that's not legal. So on their business taxes, they're not allowed to claim that as a business expense. One last comment that I want to make in here, and that is there are a lot of what ifs. Because as we've said, the government's not going to take the time to sit down and look at absolutely every situation and absolutely every receipt that you've got. So there are some things that need to sort of be factored into the game. Your book does a pretty good job of covering these, but I just want to sort of briefly bring this topic up. One of the things that gets tricky is if there is a transaction between related parties. If you're talking about a business expense of some kind that's getting paid from one spouse to another spouse or to a child, there are special rules that come into play there. Make sure that you take the time to read about that in your book. Also, is this business expense that you're putting into your tax return related to a hobby that might earn income? Let's say that you love to do boat racing on the weekends. That's fine. It's not a business expense if you're just going out and putzing around Table of the Rock or Lake of the Ozarks. But if that hobby of yours has the potential to earn you income, whether that is you're racing for competition and you may win prizes, or whether that is you're racing around the lake flying a great big banner advertising a business, well then all of a sudden that hobby could be earning you income. So with that in mind, there are some levels of expenses that could be considered business expenses. The other thing that comes into play here is your expense that you're taking on your books related to a vacation home? You may have a place at the lake. That vacation home may just be your vacation home, but you may decide that you're going to rent it to someone, let's say for 1 week out of the year. Well, because of that, the amount of time that you earned income on it could be used to calculate certain parts of the expenses that are tied to that vacation home. So, do you get to write off the electric for the entire year? No. But you could get the ability to write off some of that electric bill, or some of that insurance bill, or some of the other expenses involved with keeping that vacation home up. Make sure and pay attention to that in your book. For this last comment, I also want to spend a little bit of time talking about home offices, because there are a lot of businesses in the world who do not have a business location. My company doesn't. I work out of my home office in my house. The IRS considers a location within your home, your personal home, a home office where you're allowed to deduct off some of the expenses if that location is the principal office for your business. So for example, mine is, I take a home office deduction every year on my income taxes. The other way that this could come into play is even if you have other locations, if your home is where the taxpayer meets or deals with your clients, so let's say I could have a warehouse and a workshop that I'm paying for somewhere else in the world, but when I sit down to meet with my clients, it's in my home, then that's allowed to be considered a home office. I know that we're running a little long here, but I've got one more area that I want to cover and then we'll wrap up. And this is something that's a little outside the scope of what we normally talk about, but it's a very specific issue in the tax code called qualified business income. And here's what happened. I don't remember the exact time. Your book may mention it. I don't remember. At some point in time, let's say within the last 10 years, the government said, we want to help incentivize or encourage small businesses to come into being, to take the risk to start their company, to bring more economic power into the system. So because of that, if your business is considered a small business, we're going to let you take an additional deduction from your income so that the amount of your taxable income is decreased. And that's sort of to help you out, to help you as a small business. So if you are a qualified specific type of small business, you will get this additional income. First of all, the business itself has to be set up as a sole proprietorship, a partnership, or an S corporation, or it has to be set up as an LLC operating as one of those. What happens on this is if you fall under the criteria, and your book will go into it in more detail, and there are schedules and forms in the tax return that help the business owner figure out if they're eligible for this or not. But if you are eligible for this, the IRS allows you to do an additional 20% deduction from your total AGI before the tax that you owe is calculated. Now, to figure out if your business is eligible for this, we do all of the other calculations first. The for AGI and the from AGI. Once you have done all of that, then the system is set up to go look and see if you're qualified for this business income deduction. And if so, then you're allowed to add the 20% deduction in. Now, specific types of businesses are not allowed to use this if they have that final AGI over a set amount. I believe the amount your book's using right now is $182,100. I know this seems a little circular. You've got to go through everything first, then you calculate the qualified business income to see if you're eligible for it. And if you are eligible for it, then you go back to the AGI number again and do the deduction. But it does really help certain small businesses in the world. Okay, that's qualified business income, and that means that we're done with Chapter 6. I hope this helps. You guys know where I'm at. I won't be available the night that you're seeing this, but if you have questions or whatever, drop me notes, drop me emails. You guys are doing a great job of reaching out when there's issues that you don't understand. You know where I'm at all the time. Otherwise, I will see you back in class on Thursday.